Hi there, and thanks for joining me, Bryn Lucas, for this episode where I'm going to be revealing property expert Phil Spencer's guide to buy-to-let mortgages. If you've ever dreamt of investing in the property market, unless you have cash in the bank, you're going to need a mortgage. Now, when you're buying a property with a view to renting it out, most lenders won't allow you to do that with a standard mortgage. You're going to need a buy-to-let mortgage, specifically designed for people who plan to invest in property and become a landlord. Your first step is to find yourself a good mortgage advisor who can help you through the process. Here, we can save you a lot of hassle and hopefully money too by connecting you with our approved panel of mortgage experts. Just click the link below or visit moveiq.co.uk and we can get you started. So what is a buy-to-let mortgage? There are some key differences between this and a standard residential one. In most cases, a buy-to-let mortgage is interest only, which means you only pay the interest on the loan and won't pay off the lump sum. In the short term, this means your monthly repayments will be less than with other mortgages, but at the end of the mortgage term, you'll need to pay the loan back in full. It is possible to have a repayment buy-to-let mortgage, but most borrowers opt for interest only to keep monthly repayments down. The other thing to bear in mind is that interest rates on these mortgages are usually higher than standard mortgages, and so are the arrangement fees. Also, most buy-to-let lending is not regulated by the Financial Conduct Authority. In terms of how much you can borrow, like a standard mortgage, this depends on your income, personal circumstances, credit score, etc. However, what's different is that the maximum amount that you can borrow also depends on the rental income that you'll get. Usually, mortgage lenders insist that this is 25 to 30% more than your mortgage payments. A good way of judging how much a property might generate is to speak to local letting agents or look at the property portals to see how much similar properties in the area are renting for. The minimum deposit is usually 25% of the purchase price, though it could be more. Buy-to-let mortgages are considered higher risk because some landlords can face problems with rent collection or periods where the property is empty. The best deals, in fact, come if you can offer a deposit of 40% or more. Most big banks offer buy-to-let mortgages, and there are specialist lenders too. It's always advisable to speak to a mortgage advisor before going any further to see what options are available to you. Your advisor can also help you plan for other costs involved. Remember, when you come to sell, you'll need to pay capital gains tax if you make a profit on a property that's not your home. So if the property's gone up in value, you'll pay capital gains tax on the difference between what you paid and what you sell for. Any rent you collect is classed as income, so you'll pay income tax on that, although you can offset things like council tax and property maintenance against that. And while you may not need to take out contents insurance, depending on whether your property is furnished or unfurnished, you will need buildings insurance and you'll want landlord's insurance too. This protects you against things like loss of rent or accidental damage, for example. Now, when you're doing your calculations, do remember your property may not always have tenants in. So you need to have a plan to keep up with mortgage repayments if the property is empty for a while. At this point, you might be thinking, why can't I just get a normal mortgage and rent it out? You can, but only if your mortgage lender agrees. They may charge you a fee to give you consent, and they're not obliged to say yes. Find out more by getting in touch with our mortgage panel, and if you've ventured into property investment or are thinking about it, I'd love to hear about it in the comments below. Don't forget to subscribe, and I'll see you next time.